Unfortunately, a lot of real estate investors are like a lot of entrepreneurs, both of which are always trying to muddy the water up to make it difficult and sometimes impossible for people to jump into it. Like, for example, if you got a pool of clear water in front of you and somebody say, we want you to jump in because there's money at the bottom of it. Well, you can pretty much look down and see, okay, there's some money. Let me just jump in. It could be a couple feet of water. You're not apprehensive. You're not uncomfortable. You ain't got no fear because the water's clear and you see the money at the bottom. Now, entrepreneurs, especially real estate investors, they come along, they throw mud in the water. Now, when somebody asks you to jump in, you like, yeah, I don't even know how deep it is. You saying it's $1 million down there, but I can't see nothing. I don't know what's in it. And you're apprehensive, or you might never jump in it. Well, that's how real estate investing is. And you got to simplify it in a way to make it practical for you. And these are some of the common terms and concepts that if you could just wrap your mind around, which you ain't got to jump into the deepest part of the water to familiarize yourself and wrap your mind around these terms and concepts. Like, let me give you an example, a comparative market analysis. We call it a CMA. Now, real estate agents typically conduct them, but guess what? If you're good enough, you can get a guesstimated idea of how much a property is worth, because that's what a comparative market analysis is. When you go to a real estate agent and you say, I want to buy a property, or if you go to a real estate agent and say you want to sell a property, that real estate agent is going to conduct a comparative market analysis. They're going to conduct a CMA because they want to look at the comparative values of other properties that have sold in that market. They're probably going to look at maybe the last 3 months, and they're going to look at maybe the last 3 properties that sold to give them a rough idea of what this particular property you're looking at buying or you're looking at selling is worth. Okay, so that's a comparative market analysis. Why do you need a CMA as a real estate investor? Well, you need a CMA because you need to determine what the after repair value is of that property, and you want to determine what the gross rent could be for that property. Because if you purchase a property as a real estate investor, what are you going to do? You're either going to fix it and flip it, or you're going to buy it and hold it. Well, if you fix it and flip it, you need to know how much money you can sell it for once you fix it and flip it. What is the after repair value? If you buy it and hold it, you're going to rent it, and you got to put the rent against how much it's going to cost for you to keep it and what the expenses are associated to it. So the CMA is critical, but you familiarize yourself with ARV, after repair value, gross rent, which a CMA will give you a good idea of that. Now, again, you want to make sure that you use a real estate agent or a professional who can conduct them accurately. Of course, an appraiser will give you the best analysis because they're going to do a professional appraisal. Okay, then you have operating expenses. Well, this would assume if you bought a piece of property and rented it, how much is it going to cost for you to operate the property? If it's a single family home, the operating expenses are not going to be the same as it is a 4-unit, a quadruplex, or maybe a 10-unit commercial apartment. But you still want to know what the operating expenses are. A lot of single-family investors, they overlook operating expenses because they feel like, well, if I got a handful of homes that I rent, I'm picking up payments or people mailing them to me. I don't need a property manager. I don't need anybody to deal with that. But you're still spending money. It's just you're not calculating it because you're not thinking it through. Then we have net operating income. Your net operating income is really the gross rent less operating expenses, which will equal what your net operating income is. Now, if you're familiar with real estate, you know that net operating income, or the NOI, is critical to a commercial property. It's not as critical to a residential rental property as it is a commercial property. However, you still want to know. You still want to break the equations down so that you can be clear on how much real money you're bringing in, how much is going out, how much is left, especially if you're looking at doing burst strategies, refinances, cash outs, or if you're looking at doing some other creative strategies with that property. Then we have the debt service. The debt service is your mortgage, or the mortgage that's associated to the property. Whether you're doing conventional real estate investing or creative real estate investing, a lot of times there's going to be debt service associated to it, whether it's the existing loan if you're doing a creative deal, whether it's a new loan if you're doing a conventional deal, or whether it's seller financing where there's no institutional bank that's loaning money on it, but you are owner financing it, so the owner is going to become the bank, and that will be debt service that you're paying the owner. Then we have debt service coverage ratio. We call it DSCR. This is critical in today's world because there are a lot of loans for investors that we can get. They call them DSCR loans, meaning that your loan value or what you can borrow from a bank, your borrowing power will be dependent upon the debt service coverage ratio. So that ratio is going to be the percentage between the debt service and the operating income. So for example, if your mortgage is $1,200 and your net operating income is $1,500, or your gross rent, depending on which number they go with, that percentage, that ratio is going to determine how much you can borrow. So it plays a very important role. Then you have your cash flow. Well, if you have rent coming in, expenses going out, net operating income, you deduct debt service, whatever's left will be your cash flow. This will be the money that you know you could take home every month. Again, this is in a buy and hold or lease option scenario. It won't be in a fix and flip, because if you buy a property, fix it and flip it, you're going to be selling it. You're going to have capital gains increase, but this is going to be the cash flow. And then you have a return on the investment. What is a return on investment? Well, based on the dollar amount that you put in, you want to know the dollar amount that you're getting back. So let's say, for example, if you bought a home or rental property, you rented it out, you made cash flow every month for a year. When you calculate the total amount of money that you made for that year, you want to divide that into the return on your investment. So if you put $20,000, let's say, in to get the property, and you cash flowed a total of $2,000 that year, that would be, just for the purpose of this mathematical equation, that would be a 10% return on your investment. And your cash on cash return would be right here, $2,000. So these are simple terms and concepts that you should familiarize yourself with. I'm just kind of giving you a cram course on this video, but dig deep into these terms and concepts. Familiarize yourself with them, especially these two, because we're looking at these, but you got to remember what your cost of acquisition is. So if you're doing a conventional loan, the cost of acquisitions are going to be different than if you're doing a creative loan. So you want to know what your cost of acquisition is, meaning that how much is it going to cost for me to acquire that property? What is that total dollar amount? And you want to know, and you want to know what your cost of disposition is. See, when investors like me, when we look at purchasing a property, we're looking at our cost of acquisition. How much is it going to cost for me to get into the deal? But we're exiting the deal before we enter the deal. So we're going to reverse engineer, because we want to know what the cost of disposition is. So for example, if you bought a property and you're going to fix it up and flip it. Okay, if you just looked at your cost of acquisition, how much is it going to cost for me to buy it? How much is it going to cost for me to renovate it? You still have to consider the cost of disposition. You're going to have to pay real estate commissions. You're going to have holding costs, which should be a part of your acquisition costs. You're going to pay closing costs maybe for a buyer that comes. These are all the things that you need to consider, so that when you're putting an offer in on a property, you've already done your due diligence. You've analyzed the property, you've underwritten the property, you know what the cost of acquisition is, you know what the cost of disposition is, and you've played these scenarios out a lot of different ways. Whether you buy it, hold it, buy it, sell it, you want to know what all those scenarios are, because there's a lot of moving parts. Again, it can be complicated. People can muddy the water, but this is a good place to start familiarizing yourself with some terms and concepts that can really open you up to the endless possibilities of what real estate investing can do for you, whether it's creative real estate investing, which is my favorite, or conventional real estate investing.